All right. So my job to entertain you right after the coffee break. I hope this will work well. Thank you for being here. Thank you very much for the invitation to submit a paper to the conference, and thank you for allowing me here to speak. My name is Christian Rummer. I am working in Rwanda since about 2015. I also run a company which I'm not supposed to make promotion for, but you see it in the middle on the panel. So my goal here is to present our research that we did in empowering MSME finance in Rwanda with a pragmatic framework for domestic credit market development. So how can Rwanda strengthen its domestic credit market? And of course it matters, and I'm cutting this short because this is basically what we've talked about the entire conference of course. MSMEs represent 90% of the private enterprises, but are underserved. The credit to private sector is less than 25% of GDP, but we need to expand that in order to fulfill our mission and really grow as an economy and grow as a country through better MSME financing. I see that there are, of course, a couple of issues that we need to address. There's risk aversion, and there are regulatory rigidity restrict MSME lending, and we will get to that. There is fintechs that face scale and sustainability issues. There are standard capital weights that penalize SME loans, risk-sharing platforms we talk about, as well as customer-centric credit models. Those are the things I'd like to emphasize here. What are the problems? Technologies, first of all. Yes, we have a digital infrastructure, but fintechs often lack scale, capital integration with the banking system. This is something we need to address. Fintechs are something that is wonderful. Fintechs allow us, most of all, to experiment in ways banks would not be allowed to experiment. Fintechs can fail. If a startup fintech fails, that's sad, that's tragic, but it's not as dramatic as if a bank would fail. So banks can use fintechs to basically outsource experimenting in taking risks, in experimenting new products. That's something we definitely have to look at. Other than that, we also have to look at the fact that when we see fintechs today, we are based on a little bit of a survivorship bias because in the end of the day, many fintechs are already disappeared, and what we see are those who have survived. So we need to see really where's the value of the fintechs, how can they be more valuable, how can they get the right funding, how can they get the right scales, and potentially how can they start collaborating with banks more to really leverage the trust that a bank has with the nimbleness of a fintech. The next part that we see here is regulation. And I appreciate very much what the National Bank has done so far in this market, but the challenge in every developing market is that we are operating under what's called the standardized approach of Basel for capital regulation. That means that your microfinance loan, as well as your mid-sized SME, as well as most of your large corporates, attract the same amount of risk capital. That's something we need to work on. There needs to be a differentiation in risk capital so that really it becomes more adequate towards the risk that is taken. And even worse, if you are a bank and you invest, for example, in US Treasuries, most likely the risk weight of that investment is 0%. So that is something that might be an obstacle for the economy to grow and to allocate more capital to SMEs. Sorry, that was a little too fast. The third one is, of course, competition. We don't want this to be a competition of fintech versus banks. This needs to be a competition for the best service to the MSMEs, and this is most likely a combination of both of these business models that collaborate, that find ways to, for example, co-lend, or that find ways to embed finance into the products. But those are the things that need to work on. So we need to work on technology, on regulation, and competition. Let me give you a few ideas of what specific activities are necessary. Stronger data infrastructure. Now, we've talked a lot about data already. A lot is being calculated, a lot is being collected, but we can do better. We need to make sure that we collect sector-specific data. Rwanda is an economy that can be defined by a couple of key sectors. As a bank, as a banking group, as a banking environment, you need to be savvy of what are the key driving factors of each of these industries, that you understand them better. This will later translate also to your hiring environment, that you need to find experts of those sectors that help you understanding those sectors better. You need to have access to the alternative credit data. We always talk about MSMEs not having enough financial information. From my perspective, there are just 3 key items that you need to understand of an MSME. Invoices, inventory, and payroll. If you have these 3 information pieces, you can start analyzing an MSME. You don't need to wait until they are ready to provide audited financial statements. And thirdly, it's ESG data. Everybody talks about ESG data. We recently made a survey and asked banks, why do they collect ESG information? The answer was, oh, that helps us getting better funding. That's nice, but it's not the right aspect. ESG helps you to assessing risk better. If a company doesn't have their environmental, their social, their governance items ready, they run risk. So your point needs to be to really integrate ESG information in your credit assessment, not just in the side to fulfill some impact information or some sustainability information, but really use this data to better risk assessment. And here we have ideas about how we can actually come up with a self-assessment platform that you allow the entrepreneurs to make an assessment of ESG risk yourself. Next to data, the next part is really integrating a risk appetite framework in your MSME lending. You cannot do sustainable, scalable SME lending if you don't have the basics right. So you need to be able to calculate your probability of default, your loss given default, your exposure at default. You need to be able to calculate your expected and your unexpected losses so that you can build a risk-adjusted return on capital for your MSMEs. You need to better understand how profitable each of these MSMEs are. You need to be able to calculate these risk-adjusted return on capital so you can use them for pricing, for differentiated pricing. I know we spoke in the panel before about, in the round before, about the benefits of, or the most important aspects of cost of efficiency of operating expenses. I see a great potential for risk differentiation if we get our risk assessment right and put all this properly into a risk appetite framework in which we really allocate as a financial institution how much risk are we willing to take in a specific MSME sector, and then do that. And if we get the support from the regulators by also allowing us to differentiate the risk weights based on the risk capital, we can scale our lending to MSMEs by not much innovation other than using the tools that are already in the market, namely a good rating, a good scoring, and a good risk appetite development. By the way, on scoring and on rating, this gets me to the next point, which is basically the customer-centric business model. If you do rating and scoring, if you start replacing your relationship managers with a score, the first thing you get is people applying who have previously been declined. There is a specific benefit of having an in-person business model, a business model where you work with customers, because in the end of the day, it's still banking. It is still trust. How do you build up trust with a customer if only you give him an app where he can apply for a loan? How do you make sure the customer trusts you, the customer values you as a bank, so that he's also interested in repaying you? Because the more the customer sees value from your financial services, the more eager he is to also repay you. So yes, the technology is important, but your customer-centric business model, in which you don't think about selling loans, but solving customer problems, is more essential than that. So when you really like to build MSME lending, all these little fintech technology aspects, they are an important role. They play a role. But first of all, you need to say, I'd like to solve my client's problems. I'd like to solve an MSME's problems. I'd like to solve problems in a specific sector, and then focus on how can you do that. You build trust with the customers build trust with you, and that is the main success factor of banking still, no matter how much technology we have. A loan is still a loan. I give you money, you promise to pay me back. And this is best done based on a trustworthy relationship that is combined with technology to make it easy, but it's also built around really a customer-centric business model where you have needs-based products, where you have integrated service channels, where a customer can talk to you if he needs you, but can talk to the technology if that's more convenient. Those are the business models that you need to do. Once you have done that, you actually come to the point that you have a situation in which you as a bank are the best place to assess the risk and the best place to manage the risk, but you might not be the best place to take the risk. because your capital constraints are a problem. And I've worked a lot with impact funds across Africa who try to do MSME lending, SME lending. I can tell you, most of them fail because they don't have the proximity to the customer. They don't know the customer as well as you do. So why not working on risk-sharing concepts in which you as a bank originate the loans, manage the loans, but let banks participate. It's a much better model than the balance sheet financing that you currently get, where you get a lot of funding from DFIs, but they don't take the risk. Let's find a model where you can really share the risk, where a client comes to you that wants a $500,000 loan, you only have appetite for $100,000, but you consider the project well. There are funds outside who would love to take that risk. Of course, they also like to take the credit margin, but they are ready to take on a pari passu level risk with you. So this is a model that you have to build. First, analyze your data, use your data to build a better risk model, a better risk appetite model, use this for a customer-centric customer model, and work on risk-sharing tools so that you have an ability to really leverage the skills, leverage your knowledge, leverage your experience, leverage your stuff. That's something that's really important. So here, capacity building. You need to work on your stuff. You need to make sure your stuff is successful. I've had the experience and the research done in Germany, where I grew up, where cooperative and savings banks have a 60, 70, 80% market share on SMEs based on relationship, because they have relationship managers who work with them for decades, not an app. Not a loan officer who is there only for 2 years, but people who manage relationships. That's what we have to do. We need to work on process reengineering, on technology adoption, of course, on all those parts. We need to work on, with the regulators together, on risk assessment better. We need to use the data so that you can start potentially moving away from what is currently the standardized approach of risk-taking towards more of a foundation internal rating-based approach where you can define the probability of default, but you rely on regulators to help you with the assessment of LGD and EAD. And by that, you get a far more differentiated approach to risk management. So if you put all these things together, you really have a chance to change MSME lending if you implement an MSME-specific risk management framework as a bank. You think about risk-sharing frameworks, you foster a customer-centric business model. As a regulator, you can help reviewing the risk weights, making differentiation, using your data to do all the analysis, enable the transition to internal rating-based approaches, and keeping up, of course, with digital supervision and data policy. Fintechs can integrate into lending ecosystems, embed finance. Investors and donors can, of course, support the ability to take risks directly, not just invest into banks. And all together, we can work really on standardized frameworks, on promote data collection, and collectively work on capacity building. In the end of the day, it's still banking. It's not that complicated, but it requires the dedication to understand that clients' lending business is trust business, and we need to build this trust with our customers. Now, that was very much pragmatic, not much of science. The science is actually in our document, but I only had 15 minutes to present you 40 pages. I hope I did give you a little bit of an overview for that. Thank you.